Welcome to the ESG webinar hosted in our Thought Leadership series at OTC Markets Group. My name is Andy Kizik, and I'm a Senior Vice President and Advisor Relations at OTC Markets. Before we jump into the webinar, what I wanted to do is just go over a few housekeeping rules. Number one is that we will do a presentation, after which we'll have a question and answer session. I will ask you, if you have questions, to type them into the chat box. So after we do the presentation for roughly 15, 20 minutes, actually probably more like 20, 25 minutes, we'll go to Q&A. For any questions that may not get answered, we will make sure that answers are given directly to you. Number two is a copy of the presentation as well as an email to listen to the webinar will be available and emailed to you. It will also be available on the OTC Markets website probably tomorrow. So with that, I think that we can get started. So let's kick this off. Today, ESG, environmental and social governance, and how sustainability can boost your company's valuation. It's coming to America, so get ready. Let's go to the next slide for a second. Today, we have ACF Equity Research Managing Director Christopher Nicholson, who is the head of research and will be hosting it. ACF Equity Research is based in London. Joining Christopher is Renas Sidahmed, who is a staff analyst for sales and strategy at ACF Equity Research. Welcome, Christopher. Welcome, Renas. Let's go to the slide.
Andy, thank you very much for the introduction. We are delighted to have been invited to speak. And what I want to do very quickly first is just say how myself and Renas are going to organize this. So I will give a little bit about the company. Renas will then take on the next set of slides. I will then talk about the analytical value add part of it. And then Renas is going to help people understand what they can do to get on the pathway and take advantage of ESG. So just by way of a flavor of us and what my team is like and what our team is like, I'm just going to give you a few words. So I am MD and head of research, as Andy said. ACF is one of several businesses I have founded, and I run with my business partner and head of operations, Amalia. And when I'm not doing this, I compete mine and others' horses in the eventing discipline.
And thank you, Andy. And my name is Renas Sidahmed, and at ACF, I have a dual role, sales and strategy and staff analyst. And in my spare time, I'm a pro dancer and pro chef.
Thank you very much, Renas. Let me just tell you a little bit about ACF Equity Research. So we are an independent investment research company. We specialize in the highest specification of equity or investment research for corporate clients. We rank #1 for effectiveness, and this is independent metrics that show ACF beats leading North American and UK, EU competitors. So we're first by social media engagement measures versus our competition UK, EU, and US. We are first by social media influence. We have over 22,000 active retail investors over the collection of our private brands and handles and SM channels. And that's compared to our competitors UK and US. And we're first by Twitter activity versus the same peer group. And Twitter activity should not be confused with effectiveness, where we also rank #1. We have a global footprint. We produce institutional grade investment research to a wide investor audience. So in other words, that research is available to all classes of investors, family offices, sophisticated high net worth individuals, sophisticated and unsophisticated retail, as well as institutions, on exactly the same terms. So everybody gets it at the same time and it's equally accessible. We have an international and forward-thinking culture, and our mission is to maximize the effectiveness of capital markets for all. So that's corporates and investors, and actually other interest groups as well. Why do we want to do this? Why is this our mission? Because by doing this, everyone does better. There are more ideas in the market, there's more capital available, With more capital, you get more growth. With more growth, you get more jobs. With more jobs, you get more education. And with more education, you get more emancipation.
Christopher, thanks so much for the introduction. For everybody's benefit, ACF Equity Research is a premium provider research marketplace member for provider services at OTC markets, and has quite a lot of experience in the European markets. And I believe that as we look at ESG today, it'll give us quite a good insight into how to organize that. So Christopher, tell us and start us off, Renas, tell us and start us off with what is ESG? What does it mean? I think a lot of our companies may not be aware of it, but they are probably already doing it anyway. So Renas, why don't you kick us off with what is ESG and sustainability?
Yes, thank you, Andy. So on this slide, I'm going to cover what is ESG, or perhaps the more well-known term, sustainability. So ESG stands for environmental, social, and governance. It evolved in the 1980s from the CSR policy, which is your corporate social responsibility statement, which many of you may be familiar with, and also many companies already have. But ESG arrived because CSR was not verifiable. So what ESG does, it actually provides metrics that are quantifiable. ESG is also a discipline that improves your valuation. There are number drivers, such as increasing your cost of capital, and there are also emotional drivers, such as human capital management, which can increase employee productivity. ESG, or sustainability, is also about impact investing. And you may have heard of impact investing, or perhaps socially responsible investing or sustainable investing. In summary, though, they all refer to any investment strategy that takes into consideration both financial returns and the social sustainable efforts a company is doing. But one thing that is worth noting that I wanted to let you all know about is that there are US stats which indicate that actually only 15% of Americans actually recognize the term ESG. However, when asked the question, there are 79% that actually want to be involved in sustainable investing. They want to engage, they're interested in the idea. But the key stat within that 79% is as follows. There's 64% of the young generation, so these are your millennials, are actually pushing for ESG. And 42% of the baby boomers also want to sustainably invest. And actually, they're the ones with the real money. So what we have here is we're at an inflection point where millennials are accumulating capital, which they can either invest or begin to run institutional portfolios. But also the baby boomers are starting to consider their legacy. Okay. Next slide. Thank you. But what actually is ESG? So ESG is a set of measurable metrics, which are used by what we call the socially conscious investors to screen companies. So I'll give you just a few examples of what these metrics might look like. So for example, for the E, you might be looking at resource conservation. So perhaps what is your company doing as far as recycling? When you look at the S, you look into metrics such as equal pay or your health and safety policies. And in regards to the G, you're looking at, which is the governance, you're looking at how the board is run. What rules do they have to play by? ESG, actually, it requires a commitment and it invites verification. So it holds your company accountable and increases your credibility. It's showing investors that you are willing, but that you are being transparent. You're taking accountability for your business operations by your willingness to actually publish these metrics. And most importantly, it provides access to capital. So certain types of funds, such as sustainable funds, you've got green loans and bonds, but actually this is now flowing into your regular plain vanilla funds, or funds coming from family offices, or your sophisticated high net worth individuals, as well as retail investors.
Renas, thanks for that general intro around ESG. A lot of companies are doing it already. They're not aware of it. You mentioned governance of the board. You might have some components of it, but not all. But tell us, how and why is ESG relevant for the U.S. markets, and what has been the experience and what have you learned from the European markets that we can adapt? Because there's funds that are actually requiring companies to start adhering to it. But tell us the experience that you've had over the last few years with gathering some momentum around ESG and how it can play into the U.S. markets.
Sure. Before I touch upon the European example, I'll talk about the key drivers as to why ESG or sustainability is relevant. So the key drivers are both economic and regulatory. So what this means is that companies with ESG policies will have higher valuations compared to companies that do not. And what we know is that 93% of the world's largest companies, and this is ranked by revenues, already report on ESG. So the regulation is catching up with the economics. But what that means is that capital markets are actually already ahead of the curve. So the point that I want to make here is that there's no need to wait for regulation. It's already happening. And by waiting around for regulation, it's actually going to be a missed opportunity. So, and now going back to your question regarding the European example, we expect actually that exchanges are going to follow the European example. And there is a precedent for this, and it has to do with MiFID II, which is a European piece of legislation with a global impact. However, even though it is not a legal requirement outside of the EU, it has changed global markets' business models by its global effect on research production, its effect on portfolio manager or fund manager income statements, and also the broker and investment bank business models. So what has happened is that the top 100 fund managers said that they will only pay one way for research, which is out of the income statement. So MiFID II has actually changed that payment mechanism for the portfolio managers and making it more transparent. For corporates, this means that corporates are actually able to manage their research budgets to an actual number. So they're no longer wrapped into the broker retainer. Yes, that means there is less research that is being delivered. However, it is higher quality research. Because after all, I mean, what is the point of paying for low quality? But also for companies, they get a much better ROI, and they get a product that is relevant for all markets. And the impact of MiFID II is that soon likely it's going to enforce ESG on all companies that are public in the UK and the EU, and this is going to happen in 2021. However, I just want to make the point that this isn't the driver for doing ESG. So the driver or the reason for doing ESG is that if you don't, you are actually formally excluding yourself from about 31 trillion US dollars of ESG filtered funds. And that's according to our estimates, ACF's estimates. But however, furthermore, BlackRock actually is forecasting that there will be approximately $400 trillion by 2030 of ESG filtered funds. I mean, if you look at it, that's a hell of a CAGR. So we are racing. But it's important to note, though, that these funds are available to companies that have an ESG policy, or at the very least are on track to showing fund managers and investors that they are on this trajectory. Because the fact of the matter is that fund managers will not look at a company as an investment prospect if they don't have an ESG or sustainability policy. ESG is also important because it is becoming a global de facto primary filter. You've got investors and fund managers are now also taking stronger tactics to get less cooperative companies to pay attention. I mean, there's obviously a lot of optimism under the Biden administration. COVID-19 has also only pushed that climate agenda even further. And companies with ESG policies are actually going to end up in portfolios that outperform the major indices. And ESG-linked loans and bonds are actually will be able to provide companies with cheaper capital. The other important factor is that it communicates the state's sustainability to the markets. So it provides company credibility and value creation to the markets and to investors. So by having these measurable objectives, again, it's holding companies accountable, especially because you're willing to report on those objectives. And finally, which is why we're all here, it can boost your valuation. What we all know is that nano to mid caps are at risk because they require a constant flow of capital. So by providing investors with transparency, you're helping them to make better informed investment decisions. So to summarize it, by having an ESG policy, you're just creating transparency in the markets, which will increase investor interest. That in turn will increase your capital and increase your financial performance. And finally, it will lead to a higher valuation.
Renas, thank you very much for that. So I'm going to take the next section, and then Renas will come back to us and finish and show you some ways in which you can get on this pathway so that in the end you're left with a good feeling that it's not too scary and it's definitely worth doing. So I'm just going to move on to ESG integration as a primary filter. And what I want to try and help you here with is how this is developing at the moment. So there's a nice list on this slide of just a very small sample of organizations that in one way or another are developing policies to define what kind of metrics and how corporates should be behaving. So I'm just going to take the top one, which is the CFA, the Chartered Financial Analyst Program, just to give you an indication. So at this point, it is not a requirement for a Chartered Financial Analyst to take the ESG valuation module, but it is offered as an add-on. It's only available to CFAs at level 3 or above, but it shows you where they're going. And knowing the CFA, they will eventually make it mandatory. The other examples are very global, very international, but I'll bring your attention to SASB, which is the Sustainability Accounting Standards Board, which is one of a number of accounting standards boards globally, which operate in and out of the US. So obviously you've got US GAAP, but you've got UK GAAP, you've got IFRS, which companies all over the world choose to adopt. And then another good example is the Canadian SFI, which is North American, of course. So it's the Canada Sustainable Forest Initiative. You might think that's a bit of an odd one, but in a way, it's absolutely where we're going. They see a very, very strong interest in having companies have ESG, especially in their case on the E part, so the environment part. So they are developing standards and metrics that they want to see. And then you have, for example, the country legal instruments that are being developed. So France has Article 173, which is an ESG reporting requirement imposed on institutional investors. So it's saying to institutional investors, you have to do this filtering. But again, as Renas has been saying, it isn't the regulation that should be making you consider why to do this. It's the economics, and the markets are ahead. So what's happening here is that global FMs and institutions are pushing the ESG agenda, both, and using ESG primary filters to make their investment decisions. ESG is a global trend, both regulatory terms, but ahead of it, the economics. So how is ESG filtering used? On the one hand, it can be used to exclude your company if you're not aligned with the sustainable agenda. On the other, it's also used as a filter to identify companies that are performing well financially, or even better still from an investor's point of view, are about to start performing well financially. And this is done by calculating a company's EVA, so it's economic value added. The EVA quantifies the cost of investing capital into a business. It looks at how well a company can generate enough cash returns to be considered a good investment. But you should think of it in summary. The number of items that go into EVA is pretty complex at times, but the summary of it is that it's basically measures the entire profitability across the whole business. You can think of it as a variant of free cash flow and free cash flow margin.
Christopher, when I think about fund managers and when I think about corporate issuers that are on our markets, on OTC markets, and they're starting to engage in this, they might be reluctant to speak to investors with a formal filter. You know, one of the best tools that they have is, you know, your website is your most powerful tool and your investor relations page to kind of disclose what you have. But can't I just avoid the investors with formal filtering? How is that developing, and how is it taking charge of how companies should start addressing that?
Andy, it is a good question, and it's a very important point. And the issue is that unfortunately that strategy won't work, and that it won't work for the following reason. You've got formal and informal filtering, and I just want to cover that because it is such an important issue. So from a formal filtering perspective, what I want to just say is that the top global portfolio managers, many of whom come from the US and all of whom have bases in the US, have largely already put formal ESG filtering policies in place. So for example, BlackRock, State Street, Vanguard, Fidelity, you know, these guys, these top lists together, they have assets under management in 2020 in round numbers of 20 trillion. And it's no longer just the giants. Everyone is filtering from mid-tier through to small PMs, to sophisticated and unsophisticated retail as well. But the difference is that below the really big players, they are using an informal process, and this is the real problem. So with respect to informal ESG filtering, the problem is that as a corporate, you don't know that you have been ESG filtered, and it's unlikely that you will find out. And I say this from good experience. I was brought up in Legg Mason Investors, which is a recently merged but a huge US fund management business. And I understand how that works internally and why they wouldn't share this. And also with our discussions as an investment research house, you know, we are talking to fund managers in the US, the UK, Europe, Australia, etc., all around the world, and we have similar conversations all the time. We're not doing it formally, but we're doing it informally. So the informal tactic is used and preferred so that portfolio managers can backtest their investment policies and their return on investment before going public. In other words, they want to make sure that this does not create underperformance for them. Okay, nevertheless, the principles and ideas applied by the investors doing informal filtering are the same as the principles applied by the portfolio managers who are doing the formal filtering, the ones where you can find it on their websites or in their marketing literature. The important point here is that informal ESG filtering is the part of the iceberg underneath the waterline. You can't navigate this. And based on our experience, the assets under management doing informal filtering is far greater than the 20 trillion in 2020 that was doing it above the waterline or formally. There is an informal qualitative resistance to companies that have not joined the pathway. It is not that you might not get lucky. It is simply that PMs and investors doing informal filtering are looking for reasons not to include you in their portfolios if you do not have or are not on the ESG glide path, even if everything else looks highly investable about your business. Also, retail investors are taking an emotional look and feel approach. And what they're doing is they're communicating this via digital channels. They're commenting and sharing thoughts on social media channels around ESG. So they become very difficult to address if you don't have an ESG policy, and is ineffective to lobby them individually, obviously, which you might want to do with a large portfolio manager that's informally, that doesn't have a formal policy. But the real other issue is that for the sake of history, you want to avoid the history of those kind of comments on social digital channels. But in the end, ESG is really good for you as a company. So the first thing I want to do, if we can go to the outperformance slide, please. So the first thing I want to do is just show you the case. And then I'm going to talk about how you can actually get some value out of this for the company's valuation. So here is a really interesting, useful chart that shows what's happening to ESG. So the darker line, the dark blue line, you can see it's departing from the light gray line, and that's what you need to look at and think about. So having an ESG policy gives you access to investment funds, and here's why. The ESG rating is based on a weighted calculation score. So the indices provide a benchmark for companies that are executing sustainable business practices. And what you can see from this chart is that dark blue line, not only is it higher than the light gray line, which is the S&P 500, but that gap is getting wider. Now, at the moment, that may only be around 50 basis points a quarter, but that very quickly becomes an extremely strong competitive advantage from a returns point of view. Okay, and the index is being compared against, so the S&P 500 and the dark blue line is the S&P 500 ESG index. So what I'm trying to say here is this is an American thing. This is, yeah, we have the European experience, but it is a US thing. So the other point, index ratings. So the index ratings track the performance of the companies that have incorporated the ESG values and metrics. And the companies, the portfolio managers, the investment banks, investors, they have different ways of scoring and rating at the moment, and it probably always will be that way. However, the goal for the corporate is to be on this trajectory in order to gain access to the capital. So the key point is for smaller companies is that you do not have to have the same metrics as GSK, or you can think of any large company, Microsoft, for example. You're not going to be compared that way. So just going on to the rating scale, you can see here the MSCI has created an ESG rating system where companies are rated on a scale of CCC to AAA. The companies are rated based on what kind of exposure they have to different types of ESG risks. And the key point, they are compared to their industry peers in terms of trying to mitigate those risks, i.e. what actions are the companies taking to comply with ESG criteria versus their industry peers. And MSCI collects thousands of data points, and they're all grouped into these three ESG categories. But as I say, you are not going to be compared to a mega cap company. You do not have to be in the S&P 500 ESG index. You will be compared to your peers in the same sector with similar market caps or similar resource levels.
Christopher, as now we're getting into some of the meat of it, you know, you've given us quite a significant amount of background and insight into ESG, but let's get down into how it can affect and boost our company's valuation. And I think that we will, you know, start to look at some things we can and can't do to get there. So why don't we talk a little about valuation and how it impacts the nano cap, micro cap, small cap, while at the same time, maybe touching on the larger cap company as well.
Sure. And I think the basic principles are exactly the same. It's just a question of scale. So if you want to, you know, boosting your company's valuation through ESG, you may say, well, you know, it just sounds like a cost if I'm not already doing it. And if you are doing it, you may be wondering why you're doing it, given that you probably have audited versions of ESG if you are in the large cap space. So you can boost your company's valuation by having an ESG policy, which will improve your financial performance. And there are kind of two groups of drivers in this. I would break these up into the numbers drivers and the emotional drivers. So with respect to the numbers drivers, an ESG policy provides for greater access to capital because it lowers a company's cost of capital. So the ESG reduces your cost of capital by introducing better capital discipline, which leads to a lower cost of capital, so a lower WACC. And amongst peers, the lowest WACC over time wins. Now, we haven't just made these numbers up, and they're not just based on our capability as a smaller firm to be able to go and get these numbers. These numbers come from big organizations, big fund managers, and this is what the stats say. So you can improve margins. So firms without an ESG experience higher costs related to, for example, and this is just an example that might resonate with the audience, environmental breaches. So you end up with an environmental breach because, for want of a better word, the team's eye has not been able to be on the ball quite as much as it should, which leads essentially to sanctions. You call them fines, call them legal sanctions, whatever you want. But essentially, that also then leads to loss of revenue opportunities, either because you're fighting the sanctions or because the sanction means you're out of part of the game for a period of time. On the other hand, it can increase revenue opportunities. Now, it's two ways in which it does this. If you have an ESG, and given what we've said about 80% of people actually want to be involved in sustainability investing and buying, therefore, sustainable products, etc., when they're asked the question in that clear way, when we consider that, the point is that if you have an ESG policy, your brand becomes more attractive. And this is business to business as well. You've got the same issue with suppliers and your partners. Those that have ESG don't want to partner with people who do not have ESG because it undermines their ESG efforts. And again, you're not going to find out because they're going to stop the conversation pretty quickly, but politely, of course. Now, the other aspect of this is that if other firms in your sector are experiencing a revenue loss because they have got into problems related to not having an ESG, our sanctions example on environmental breaches, then you have an opportunity in the same sector by default to have customers divert to you, both B2B and B2C, because you do have ESG. Okay, so without it, you're suffering brand damage. With it, you're suffering you are benefiting from brand enhancement. With respect to the emotional drivers, if a company does not address the human capital management issues, this causes a decrease in employee productivity. Again, not our stats, they're commonly available. Loads of people have done good research on this. And you have a reduction in morale, and this increases staff turnover. So we estimate that for smaller companies, the cash cost for staff recruitment is about 50% of salary, plus time, plus opportunity cost. We focus on these things because most smaller and mid-sized companies, in the end, they are often led and run by 2-3 senior executives who pull all the levers. We say it's 50% because of the following. So initially in my example, I'm going to include the headhunter cost. So 50% because the headhunter will charge between 20 to 30% of annual salary, and that commission may spread over 12 to 24 months. You're already at 50%. If you factor in hourly costs of CV research and interviews and cost of onboarding, and at that stage, your new people are not generating margin, then you add the opportunity costs, so your time as senior execs or your key team members spent training, coaching, etc., you get way over 50% very, very quickly. And that is why staff retention is such an issue. When you actually break down the numbers, which, let's face it, is kind of the job of a research house, an investment house. When you break down the numbers, they are horrible. I mean, we all sense it, but knowing the numbers, they're awful. So increased interest in ESG, essentially what that creates through internal discipline and perception. So it's both things. It's the internal discipline it creates because you've got to make these metrics public, really focuses the mind. And then it's the perception you create as a result of making them public. It leads to high performance stock. That means a stock that is of interest and demand for all classes of investors. And that, of course, leads to higher valuation. So if we can go to the next slide, thank you. So ESG also boosts your company's valuation by driving higher profitability. We kind of touched on that on the previous slide, but I just want to go a little bit more into that. So with a higher ROIC, so return on invested capital, you also have characteristics like lower volatility. So I'm talking about stock price volatility there and trading volumes volatility. And if you can improve your profitability, improve your ROIC, and lower your volatility, I mean, that is just a given that you will end up with a higher valuation. So how does ESG create or increase the economic value added or the total profitability of a company? Well, again, I touched on a little bit, but the higher the ESG performance, the higher the EVA margin, so the economic value added margin. So ESG introduces further capital management discipline. And I know a lot of you out there, especially those of you who are natural entrepreneurs running your first, second, third, fourth, fifth business in the public markets, you will take the view that you have capital management discipline. But what I'm talking about is I'm talking about the marginal improvement in capital management discipline. Because in the end, capital markets are always interested not in your absolute performance, but your relative outperformance. So it is at the margins. It's like top sports people. It's at the margins. So low ESG performing companies have higher volatility and lower return on assets, so low return on ROA. That's where all the stats show us. Companies with an ESG policy tend to have a higher valuation multiples for some of the reasons I've described, but particularly for PE, for price to free cash flow and price to book. What's happening is that investors are rewarding higher actual, or, and this is where the perception part comes in, potential EVA margins. So they're rewarding higher overall firm profitability, or what they think is going to become higher overall firm profitability. So high ESG performing companies return more capital to investors. So this is where the investor side comes in. This is why they're interested. Now, investors know this. So by some association, you are likely to get a better rating if you are on the high ESG performance side. By better rating, I'm using investment analyst speak to mean that instead of being worth, say, 8 times enterprise value or market cap to EBITDA, you'd be worth 10 times. So you get extra turns, better rating. High ESG performance is worth about 6% outperformance to portfolio managers, according to the research that is out there. We would cite the research, for example, from ISS. Over 5 years, that makes a huge difference in outperformance. In the end, the portfolio manager only has to outperform its peers. You recall I said it's all about relative performance, not absolute. And if it can outperform its peers by making an investment filter decision, that is a good enough reason to informally or formally exclude companies without an ESG policy and immediately look at the next investment case. So just borrowing on my Legg Mason Investors experience again, the way this works is in practice, they will take a look at the website. If it's not there, they will move on to the next. Remember, there are 10,000 listed stocks in the US. They have a lot of choice. If you investigate this for yourself, and of course I recommend that you do, and I recommend that you do get up to speed because it makes it easier for us to talk with you all if you're up to speed. If you investigate this for yourself, you may find periods of exception, and you should note the following. 2013 to 2015, there was a dive across the entire markets globally for EVA margins. And this was because of the manufacturing recession and the rise of online retailers such as Amazon coming about at the same time. So what you got was a recession in manufacturing and essentially a technological shock. Then in 2017, 2019, EVA margins rallied across all the markets, but really it was driven by 2 sectors, the financial sector and the energy sector. And what you saw here, what the numbers describe is the recouping of lost or negative margins. So they were going from losing money and suddenly jumped back into making money.
Christopher, I'm a CEO, let's say, in a small cap, nano cap, micro cap company. Why don't we get started and how do I get started? What do I need to do? Let's kind of go through what are some of the real actionable items that a company can start to take to really improve their ESG internal policies.
Actually, Andy, I'm going to hand this back now to Renas because I think everybody's heard enough of me, and she has a nicer voice, and also she knows this really well.
Thanks, Renas.
Okay. Thank you, Christopher and Andy. So before I jump right in, I just want to give you 3 elements which make us confident in what I'm about to tell you as far as what you would need to do. So the first is that the main ESG indices are based in the US. The second element is that we, ACF, work with the EU and UK and other regions that have ESG policy and want to get rated on US indices. And finally, we talk to and are talking to investors of all types that are applying informal filters. But the main message I wanted to tell you is that it is doable. Implementing an ESG policy is doable. And so what we see for small companies is that there's a lot of low-hanging fruit. But implementing an ESG policy now will increase your investor interest. Or if you put it another way, it will prevent you from being excluded. So the first thing is start with what you have. So you want to show the direction of travel. You want to show that you're on the path of ESG. As we've mentioned several times throughout the presentation, you're only going to be compared with your peers. So as a small company, you're not going to be required to produce the same metrics as a mega cap company. And there's also not going to be a need for a lot of audited metrics. So therefore, you don't need to consider any major investments in your financial reporting systems. The goal is to get on that bandwagon and just start publishing a few metrics, just to making sure that your company is on the right path. And as I mentioned earlier on, you don't want to wait until the regulation becomes a forcing action. That is going to show the markets and investors that you are on the wrong side of history. And actually, you may even get a valuation discount for being seen in that way. So you want to show the investors that you're actively focusing on ESG, and you want to get that message across and out into the markets. And for example, if you are on the OTCQX or QB, you're already a step forward in terms of governance. So that's the G of the ESG. So you're already 1/3 of the way there. Because by being listed on these markets, so you're showing that you're owning your company's disclosure, you're adhering to best practices.
So with the initial low-lying fruit, what do I need to do? Let's start getting into some of the details, and let's talk about the journey, Renas.
Sure. Yes. Thank you, Andy. So you want to set your trajectory. You want to set out 3 areas. So the 3 areas of policy, the E, the S, and the G, with targets. But obviously, you want to also set yourself some realistic targets, and make sure that they are achievable, because again, your credibility is at stake. So, for example, you'll say in year 1, you're setting these set of targets, and then year 2, I'm setting another set of targets, but making sure that you've achieved the set of targets that you set for year 1. If you have a process, make it public. Again, you want to make sure the information is getting out there to the markets, but also by making it public, it will help you focus on whether it is effective, ethical, fair, and contemporary. You might say your business perhaps doesn't emit much carbon. That's excellent. But then you say that, and you want to show how low your carbon footprint is. Or perhaps your company doesn't create environmental pollutants. That's great as well, but ask yourself 2 questions. The first one, are you sure? And secondly, if you are, then you say so. And in that case, your metric would be 0. Or another example, my company has 2 execs on payroll and everyone else is a consultant. Again, record that, say that, and then once you've reported that, you can also do your male to female ratios or your ethnicity ratios. And also in regards to the consultants, maybe you want to talk about how they're treated in your company compared to full-time employees. So for example, if you run your firms anything like how we do at ACF, you would know that good consultants become part of the company family. You might also want to talk about your training programs, the work environment, or how much you spend on average per head on training, or how much focus time is allocated per week or per month on professional development. In addition, also you want to take advantage of the OTC, QX, and QB markets to distribute research on your ESG increased valuation. For US companies, for example, the QX, QB can facilitate the pathway to ESG by providing visibility through the publication of third-party research. For non-US companies, home markets can provide corporate and financial disclosures, and of course ESG as well, to North American investors. And those might include institutions, funds, or family offices and retail investors. And then finally, talk to ACF, talk to us. We can help you in getting this, in starting this journey and in getting you on the right path and setting your trajectory.
Thank you, Renas and Christopher, for the presentation to get started into ESG. We are open to taking questions, just some housekeeping items. This presentation is made available. You can check the handout section. It'll also be emailed to you. Let's go to questions. Any questions that are not answered will be answered after the session by email by Christopher or Renas. Kicking off the questions, I'd like to go to one question. Christopher, what, if any, are the latest SEC initiatives to address ESG? Any updates, thoughts, or questions around how the Biden administration, what the SEC is starting to do?
So Andy, I'll kick that off, and if Renas has anything to add to that, she'll just step in after me. So I'm just going to do that on a top line and say it's really, really interesting what is happening. The Biden administration will undoubtedly support what is about to happen, but the SEC has already taken the initiative. There have been a couple of papers out the last few days. There was one out yesterday which said once Gensler gets his nomination, they're going to go out to the public and seek help to understand how they should frame ESG initiatives. They are intending to plow ahead, and plow ahead is on their press release, not on ours. So it's coming, and that was yesterday. Renas, do you have anything else to add? Do you want to add to that?
No, I'm good.
So now that the SEC and the regulators are starting to take initiative, it's starting to become a real matter here in the US. And I think that the public forum and comment period will really start to do that. So stay tuned to SEC News on ESG as well. We have another question coming up, and I think it was mentioned a little bit, is in terms of research reports. Are research reports reflecting and highlighting ESG compliance in their reports as a specific item in the report? How is your research community treating that to highlight the metrics or the initial framework around what companies are doing for their own internal ESG?
So this is a really interesting point, Andy, and our experience is as follows. As of February, mid-February, we had clients coming to us saying, can you please include, when we were having our valuation debate with them, they were saying, oh yes, but can you please include our ESG policy and our ESG metrics? Now that hasn't happened before. So that is new. And in fact, in one example, we had to say to the client, there are no metrics here. It's not going to have an impact. But we think our first investment research report for our clients that actually incorporates ESG as part of the investment case, that will be out in April. And the other thing that we've noticed is that over March, these requests from our clients become thick and fast now.
Thank you, Christopher. I've got another question regarding source of information guidelines and framework here. Let me read it directly. Are there any examples of good ESG policy statement and or reports on the web, and or are there any utilized public sources that might be a good start for a small cap company or micro cap company to initiate with?
Renas, do you want to take this or shall I? Okay, so there are examples. There are lots and lots of examples. There is lots of information all over the place. They're all slight variants, etc. Different sectors have different requirements, or I should say investors looking at different sectors are expecting different sets of metrics. You can imagine that the metrics expected for a mining company are very different to the ones expected for a small IT company. I think the problem probably is there is too much out there, and it is difficult for smaller companies to have the resources and the teams to put together to figure it out. You can definitely do it. I mean, we had to make the transition to become experts in the area. It took us a while, and it took a reasonably big team to get there by the scale of our business. You can definitely do it for yourself, though. I think we gave SASB as an example in the list. You could go to the chartered accountants, not chartered accountants, the Chartered Financial Analyst site, the CFA site. Have a look at what they are including in their module. It'll give you an idea of how investment analysts are being asked to consider the matter. And I think that's a pretty good steer. But the skill really is to look at your particular sector, look at the variance, try and find the common threads, and then try and nuance your particular version so that you can appeal to the investors in your sector, or you may even have a handful of cornerstone portfolio managers specializing in smaller caps that you really want on board, in which case nuance for them. Problem is, a lot of them aren't doing it formally, but we can help you with that. It's certainly a discussion we can have. And of course, as you might expect, we have products that can help with that as well. But you could also take a look at our site. We just today, to tee up this webinar, we published our ESG. Now, we are not required to have an ESG. We are a small private company. There is no requirement, and unless we went public, there would not be a requirement at our scale to have to publish any kind of ESG. But we think it is a great discipline and tool to increase our own EVA and to improve our staff retention, which is already very, very high, but there is no harm in trying to get marginal improvements on that.
Okay, we have a few more questions popping up. Thank you, Christopher. I've got one coming. We have a large group of mixed domestic and non-US companies on the call, but here's one. I'm a European large cap issuer that's quoted on the pink market. I'm already adhering to local standards for ESG, but how does my company benefit from this into the US?
Renas, do you want me to take it? Okay. So the reason you benefit in the US is that you probably already have this stuff in place. And I would say the other thing is that coming to the US means, as you probably know as a large cap, you are coming to the world's greatest pool of capital. But everybody knows that, so it's also the most competitive pool of capital. I think the release from the SEC yesterday really tells you where the US is going. So it's going to become, I don't want to say mandatory, but there is going to be a lot of drivers to push people to having these policies. But I think, again, if you are a large cap, then your investor audience is the likes of BlackRock, Fidelity, etc. So you should have it in place. And if you don't, they won't be able to touch you. So if you come into the US, you've got a lot of it. You come to, say, the OTC, you move up to the QX and QB, you'll be able to port over your governance from Europe or wherever you have been to OTC, QX, QB, and then you're 1/3 of the way. But I'd be surprised if, as a large cap, you don't already have the policy. And I'd be surprised if, even if you don't have a formal policy, you don't actually already have a lot of metrics which you could have audited. I mean, incrementally, it's not going to be a huge amount more than your regular audit. For a smaller company, that's a different matter. It would be significant. But for a large cap, you probably have most of it there. You just need to pull it out of your reporting systems and present it. And if you're a large cap, you want to be aiming for one of the big indices. So get it audited. That's part of the requirement for the large indices.
Thank you, Christopher, for that. I've got another question coming in. Can you provide any examples of ESG leaders in the mining and exploration industry and how it impacts that industry and sector?
Yes, We can. I just can't name them at the moment because they're under Rule 8.2 in the UK, which means we can't talk about them. But they are a client, and when they come out of 8.2, they will be we think, a potentially very strong example of how a smaller cap company has benefited from ESG and part of its valuation. And we intend to put out a separate note examining how that helps the valuation stack.
Understood. Understood. Jumping on to the next question in the last few minutes, we have aligned ourselves as a company with the UN directives. Would you recommend that as a good approach, or is there maybe a shifting that would have to occur? What's a good standard practice to maybe adopt if you're with the UN?
Okay, so Andy, I can talk forever about this, but Renas actually worked with these multilateral organizations as a professional. So I am actually going to put her on the spot and get her to answer this.
Thank you, Christopher. Well, I mean, I think, so given the question, I think that it is a good approach. I am aware that a lot of companies are actually using the UN SDGs as sort of a starting point when they are looking into ESG and sustainability, because it does cover a wide range of areas. However, again, it is general, and the point of ESG is that you are going to be compared to your peers, so you need to consider your own metrics and understand what those are compared to your peers. But yes, it is. I think it is a good starting point, and it is a good approach.
Thank you, Renas. I'm going to be reading the questions a little bit quicker. Here's an elephant question. How do we approach the cost of an audit for a framework? And I think we mentioned in an earlier slide that as part of the research, you look at this, but what can one expect, Christopher, in terms of kind of getting started? What, maybe you can shed some general light around this question.
Yeah, I think smaller companies. So I'm gonna tackle this from the large cap end and from the smaller cap end. So I'm going to talk about the smaller cap first. So I think from the smaller cap end, the point here is you can get going, get on the pathway. It is quite low hanging fruit, and as a result, you're not looking at $200,000 of fees. I would also say the following, that get started, because even if you don't buy my Analyst's economic argument, and there are plenty of stats you can back check this on, but even if you don't buy it in the end, then you will be waiting for the regulation to force you. And when it arrives, you will not have very much time to get it together. Also, it will then become apparent that you face a real problem. So the tip here, or the guidance here, is get started, because then when you really decide to get really formal, either you decide to get audited or suddenly the regulation creeps up on you. And I think when I say creep up, I mean rockets up on you. You will be halfway down the pathway to getting it formalized. And that's the key, because then it's much easier to digest and you are in a much better position to actually have the cash resources aside.
Christopher and Renas, we've run out of time. We have to wrap it up here. For any questions that weren't answered, we'll get them to you, Christopher. You can respond directly to the participants. I want to thank everybody for joining us for the thought leadership. If there's any questions or concerns, please reach out. And again, thank you for quite an informative start to this wave that's coming to the US.